For a long time, stability has been sold to us as the ultimate goal of the economy. Stable prices, stable growth, stable markets. It sounds comforting, predictable, safe. But what if stability isn't the protection we believe it to be? What if, instead, it quietly plants the seeds of the next crisis? Because in modern economies, stability doesn't just reduce risk. Over time, it can actually create it. And by the time that risk becomes visible, it's usually too late to avoid the consequences. Think back to the moments just before major financial crises. The late 1920s. The mid-2000s. Even the years leading up to the pandemic. On the surface, these periods shared a common feature: calm. Markets were steady. Inflation appeared under control. Economic growth seemed reliable. Volatility was low. Confidence was high. Nothing felt urgent. Nothing felt dangerous. And that was precisely the problem. Stability changes how people behave. When the world feels predictable, caution slowly fades. Risks that once seemed unacceptable begin to look reasonable. Decisions that would have been questioned during uncertain times start to feel normal. This shift doesn't happen overnight. It unfolds gradually, almost invisibly, as confidence builds and memories of past crises fade. To understand the hidden cost of stability, we need to look at how modern financial systems are designed. At their core, economies run on expectations. Businesses invest based on anticipated demand. Banks lend based on expected repayment. Households spend based on perceived job security. Financial markets price assets based on forecasts of the future. When the environment appears stable, these expectations become more optimistic. And optimism, while essential for growth, can also encourage excessive risk-taking. Central banks play a central role in fostering this sense of stability. Their mandates often focus on maintaining low inflation and supporting employment. To achieve these goals, they adjust interest rates and manage liquidity within the financial system. After a recession, central banks typically lower interest rates to stimulate borrowing and spending. This policy helps stabilize the economy and restore confidence. Over time, however, prolonged periods of low rates can lead to unintended consequences. Cheap borrowing encourages households to take on larger mortgages, businesses to expand aggressively, and investors to search for higher returns in riskier assets. What begins as a stabilizing measure gradually transforms into a driver of vulnerability. This dynamic is sometimes referred to as the stability paradox, a concept closely related to economist Hyman Minsky's financial instability hypothesis. Minsky argued that stability itself can lead to instability because it encourages economic agents to assume that favorable conditions will persist indefinitely. During stable periods, financial behavior evolves through three stages. First comes hedge finance, where borrowers can comfortably meet both interest and principal payments from their income. Risk is relatively contained, and the system appears resilient. Next is speculative finance, where borrowers can cover interest payments but must refinance or roll over the principal. The system becomes more dependent on continued access to credit. Finally, Ponzi finance emerges. In this stage, borrowers rely on rising asset prices to service their debts. If prices stop increasing, the entire structure becomes fragile. These stages are rarely obvious in real time. Each step feels like a logical response to a stable environment. Yet collectively, they transform stability into a source of systemic risk. Consider the housing boom leading up to the 2008 global financial crisis. In the early 2000s, the global economy experienced a period often described as the Great Moderation. Inflation was low, economic growth was steady, and financial volatility appeared subdued. This stability encouraged banks to loosen lending standards and investors to seek higher returns through complex financial instruments such as mortgage-backed securities. Homebuyers, confident that prices would continue to rise, took on increasingly large mortgages. On the surface, the system looked robust. In reality, it was becoming dangerously fragile. When housing prices began to decline and interest rates rose, the intricate web of leverage and interdependence unraveled, triggering a global crisis. Stability also affects how risk is perceived and measured. Financial models often rely on historical data to estimate the likelihood of adverse events. During extended periods of calm, these models tend to underestimate the probability of extreme outcomes because recent data contains few examples of volatility. As a result, institutions may hold insufficient capital to absorb shocks. Risk management systems, designed to protect the financial system, can inadvertently amplify vulnerability by reinforcing a false sense of security. This phenomenon is sometimes described as risk compression. When volatility is low, assets appear safer, encouraging greater leverage and tighter risk premiums. But when conditions change, this compressed risk can expand rapidly, leading to sudden and severe market corrections. Another hidden cost of stability lies in the accumulation of debt. Stable economic conditions make borrowing appear safe and manageable. Governments issue more bonds to finance spending, corporations increase leverage to fund expansion or share buybacks, and households take on mortgages and consumer loans. Over time, debt levels can rise significantly relative to income. While manageable in a stable environment, high debt becomes a major vulnerability when interest rates increase or economic growth slows. The global financial system today carries substantially more debt than it did several decades ago. According to international financial institutions, global debt has surpassed 3 times the size of the world's annual economic output. This expansion reflects the cumulative effects of prolonged stability and accommodative monetary policies. Debt, in itself, is not inherently harmful. It can support productive investment and economic growth. However, excessive reliance on debt reduces flexibility and increases sensitivity to shocks, making the system more fragile. Stability can also contribute to rising economic inequality. When central banks maintain low interest rates to support stable growth, asset prices such as stocks and real estate often rise. Individuals who own these assets experience significant increases in wealth, while those who rely primarily on wages may see little immediate benefit. This divergence can widen the gap between different segments of society. Over time, increased inequality can have broader economic consequences, including reduced social mobility and weaker aggregate demand. Moreover, the perception that stability benefits only a portion of the population can erode trust in economic institutions. When official indicators suggest that the economy is performing well but many individuals do not experience corresponding improvements in their financial well-being, skepticism naturally emerges. There is also a psychological dimension to stability. Human behavior is deeply influenced by recent experiences. When people go for long periods without witnessing economic turmoil, they may begin to believe that such events are unlikely to occur in the future. This phenomenon, sometimes referred to as recency bias, leads individuals and institutions to underestimate the possibility of extreme outcomes. As memories of past crises fade, the willingness to take on risk increases, further reinforcing systemic vulnerabilities. Ironically, the very success of policies designed to stabilize the economy can make future crises more likely. By smoothing short-term fluctuations, these policies may encourage the buildup of long-term imbalances. Technological and financial innovation adds another layer to this dynamic. During stable periods, innovation often accelerates as investors search for new opportunities and higher returns. While innovation can enhance efficiency and expand access to financial services, it can also introduce new forms of risk that are not fully understood. Complex financial instruments, algorithmic trading, and interconnected global markets can amplify the speed and scale of financial shocks. When combined with high leverage and compressed risk premiums, these innovations can transform localized disturbances into systemic crises. It is important to recognize that stability is not inherently undesirable. On the contrary, stable economic conditions are essential for long-term planning, investment, and social well-being. The challenge lies in managing the unintended consequences that can arise from prolonged periods of calm. Policymakers face a delicate balancing act. Tightening monetary or regulatory conditions too early can stifle growth and trigger unnecessary downturns. Waiting too long, however, can allow vulnerabilities to accumulate, increasing the severity of future crises. This tension creates what might be described as a policy dilemma. There is no perfect moment to intervene, and decisions must be made under conditions of uncertainty. As a result, the path from stability to instability is often shaped by a series of incremental choices rather than a single decisive action. Another hidden cost of stability is the illusion of control. Modern economic systems rely heavily on sophisticated models, data analysis, and policy frameworks. While these tools provide valuable insights, they can also foster the belief that risks are fully understood and manageable. History repeatedly demonstrates that economies are complex adaptive systems, influenced by countless interactions and feedback loops. Unforeseen events, whether financial, geopolitical, or environmental, can disrupt even the most carefully managed systems. The perception of control can therefore lead to complacency, reducing the incentive to prepare for low-probability but high-impact events. When such events occur, the consequences can be severe. To visualize the hidden cost of stability, imagine the economy as a bridge designed to support increasing levels of traffic. During periods of calm, more vehicles are allowed to cross, and the bridge appears to function smoothly. However, if the underlying structure is not reinforced, the cumulative weight can eventually exceed its capacity, leading to a sudden collapse. In this analogy, stability encourages greater usage of the system, while the gradual accumulation of risk weakens its resilience. The collapse, when it occurs, seems abrupt and unexpected, even though the underlying vulnerabilities have been building for years. So why does this pattern persist? Part of the answer lies in incentives. Financial institutions benefit from increased lending and investment during stable periods. Governments gain political support from sustained economic growth. Investors and households enjoy rising asset values. These incentives create a collective tendency to prioritize short-term gains over long-term resilience. Addressing emerging risks often requires unpopular measures, such as tightening credit conditions or implementing stricter regulations, which can be politically and economically challenging. Additionally, the global nature of modern finance complicates efforts to manage systemic risk. Capital flows freely across borders, and policy decisions in one country can have significant spillover effects elsewhere. Coordinated international action is often necessary but difficult to achieve. The hidden cost of stability is not limited to financial crises. It can also influence the broader trajectory of economic development. Persistent imbalances, such as high debt levels and rising inequality, can constrain future growth and reduce the economy's capacity to respond to new challenges. Moreover, repeated cycles of stability and crisis can erode public trust in institutions, leading to social and political tensions. When individuals perceive that the benefits of stability are unevenly distributed while the costs of crises are widely shared, dissatisfaction and polarization may increase. Despite these challenges, understanding the hidden cost of stability provides valuable insights for policymakers, investors, and individuals. It encourages a more nuanced perspective on economic conditions, emphasizing the importance of resilience alongside growth. For policymakers, this may involve implementing macroprudential regulations, maintaining adequate capital buffers, and monitoring systemic risks beyond traditional economic indicators. For investors, it highlights the importance of diversification and long-term risk management. For households, it underscores the value of financial prudence and preparedness. As we look at the current global economic landscape, many familiar signs of stability are once again present in various regions: relatively low volatility, strong asset markets, and sustained policy support. While these conditions offer opportunities, they also warrant careful scrutiny. The key challenge is not to eliminate stability but to recognize its potential side effects and address them proactively. By acknowledging the hidden costs, societies can strive to build economic systems that are both dynamic and resilient. Ultimately, stability is a double-edged sword. It provides the foundation for prosperity, yet it can also sow the seeds of future instability. The relationship between the two is complex and deeply intertwined, shaped by human behavior, institutional incentives, and the structural characteristics of the financial system. So the next time headlines celebrate a period of economic calm, it may be worth asking a deeper question. Not simply whether the economy is stable, but whether that stability is masking the buildup of risks beneath the surface. Because history suggests that the greatest dangers often emerge not during times of turmoil, but during the quiet moments when everything appears to be under control. And perhaps the most unsettling question of all is this: if stability itself can plant the seeds of the next crisis, can any economic system ever achieve lasting balance, or are we destined to navigate an endless cycle where calm is merely the prelude to the storm?